All right, let's dive in. You know, the world of financial technology, fintech, is always changing, always moving. Today, we're going to break down three really big power moves that are happening right now. A quest for total control, a hunt for cheaper money, and a big play for public credibility. Let's get to it.
I mean, this quote just nails it, doesn't it? It perfectly captures the vibe in fintech at this very moment. You've got this massive potential, this incredible climb. But at the same time, there's this tension in the air, a real uncertainty about what's around the corner. It makes for a super high-stakes, fascinating space to watch.
So, here's how we're going to break this down. We're going to look at these themes through the eyes of three very different companies. Each one tells a unique story about what it really takes to win in fintech today. And we're going to start with that quest for control.
Okay, first up, Mercury. Now, if you're in the startup world, you know them. They're a big deal. But they're making a move right now that shows they have ambitions way, way beyond their origins. So, you gotta understand, Mercury built its entire brand on being the slick, easy-to-use banking platform for startups. And the way they did that was by partnering with old-school banks behind the scenes. But now, they're applying for their own national bank charter. That's basically the government's official license to be a bank. And that move, it totally flips their entire model on its head. This isn't just a new product feature, we're talking a fundamental change in who they are.
And this is where it gets really interesting. The source material uses this brilliant analogy, renting versus buying a house. Renting, by using a partner bank, is fast. It lets you get up and running quickly. But, your landlord can always raise the rent, or worse, just kick you out. Owning, on the other hand, getting your own charter, it's a slower process, comes with way more responsibility, but you control your own destiny. You have sovereignty.
And that right there gets to the absolute heart of it. Relying on other banks, especially after all the turmoil we saw after the SVB collapse, it creates what the source calls an existential risk. So for Mercury, this whole move is about getting ultimate control, about finding stability. It's about making sure their foundation is rock solid for the long haul. And it makes you wonder, right? Are we about to see a whole new wave of fintechs trying to become the very banks they originally set out to disrupt?
So, at the end of the day, what Mercury's doing is making a massive strategic trade. They're giving up that quick, nimble agility that made them famous, and in exchange, they're getting the power and the independence that comes from owning your own infrastructure. It's a huge, calculated bet that owning the rails is always better than renting them.
All right, let's switch gears. Next up, Klarna. While Mercury is all about owning the old rails of finance, Klarna is tapping into something brand new to get its hands on cheaper, faster money.
Yep, you heard that right. The buy now, pay later giant Klarna is working with Coinbase to use stablecoins. But hold on, this isn't about crypto hype or speculation, not at all. They're using what the source calls boring crypto for a very practical, real-world business need, getting access to funding. So you might be thinking, okay, what is a stablecoin really? Well, the easiest way to think about it is like a digital dollar. It's designed to hold its value, just like a dollar bill in your wallet. But it lives and moves on the internet, and that means it can zip around the globe almost instantly, 24/7.
And this is how it works. It's actually pretty simple when you break it down. Big-time institutional investors can fund Klarna directly using this technology, which makes the whole thing cheaper and way more efficient. But the absolute magic trick here, it's step 4. The customer who's checking out and using Klarna to buy something has no clue any of this is happening. It's all behind the scenes, a pure infrastructure upgrade.
Okay, I love this analogy. It's so perfect. This isn't Klarna being some crypto rebel. This is Klarna being smart and sophisticated. It's like wearing sneakers with a suit. It says, I respect the tradition, but I also understand the future. It shows that crypto is maturing, moving away from just wild speculation and becoming part of the boring, practical, and incredibly useful plumbing of finance.
And that is the real takeaway here. When a technology becomes invisible, when it just becomes infrastructure that works, that's when it's really won. Klarna isn't trying to make some big ideological statement. They're just using a better, more efficient tool to get the job done.
All right, on to our third and final power move. Let's talk about Plaid, the quiet, absolutely essential giant of the fintech world and its very long-rumored debut on the stock market.
Look, I can almost guarantee you've used Plaid, even if you've never heard the name. Anytime you've connected your bank account to an app, Venmo, Robinhood, whatever it is, you are probably using Plaid. They are the pipes, the wiring, the fundamental plumbing that makes the whole modern fintech world work.
So what's the deal with their IPO? Well, the latest analysis puts the odds of it happening in 2026 at about 50-50. And in the world of IPOs, what that really means is the company itself is ready to go.
The business is there, but the market, the overall economic climate, that has to be just right.
And this really gets to the core of the problem, right? It's not like anyone is questioning if Plaid is a real, solid business. It absolutely is. The real question is whether public market investors are ready to appreciate and properly value a company that's less like a flashy app and more like a utility. You know, kind of boring, but absolutely essential.
I mean, look at why they're so solid. Their revenue comes from a bunch of different places. Their customers are incredibly sticky because once you build your app on their plumbing, it's really hard to switch. They are essential infrastructure. And because of all that, they don't have to depend on the next wave of consumer hype to survive.
So when you boil it all down for Plaid, it comes to this. Their success as a public company isn't going to depend on buzz or some flashy story. It's going to depend on finding a market that actually understands and respects the incredible value of building the quiet, necessary foundations that everyone else relies on.
Okay, so we've looked at 3 totally different companies, right? 3 different power moves. What does it all mean when you put it together?
And this table just lays it all out so perfectly. You've got Mercury, chasing that bank charter for ultimate control. You've got Klarna, using stablecoins for cheaper, better capital. And you've got Plaid, getting ready for an IPO to get that public market credibility. Control, capital, and credibility. You could call them the 3 C's of fintech power.
And all of this, it really boils down to one huge underlying question. Each of these moves, in its own way, is about controlling a piece of the financial infrastructure, the rails that our money travels on. And at the end of the day, the biggest winners in fintech won't just be the ones with the coolest apps. They'll be the ones who figure out how to own those rails and get paid for it. Thanks for tuning in.